Power on the markets. Good to see you again. You told our producers today, quote, the market continues to believe that this aggressive hiking cycle is unlikely to end well. Isn't it exactly the opposite?
Well, we have the tale of two different markets. So the rates market is saying, the end of the world is coming. You can see that with the inverted yield curve, whereas the equity markets is like party on. So it's a very interesting dynamic. I'm not saying one market's going to be right over the other, but the bond markets are still like you can own a 3-month T-bill or a 6-month T-bill and get paid more yield than a longer dated bond. So this inverted yield curve is not a healthy sign. It's a sign that the rates market thinks the Fed is going to over tighten policy rates and is going to slow growth. But equities, I think, really saw this as a relief that we didn't have as hawkish commentary yesterday as we have historically.
I mean, you were expecting hawkish yourself from my conversation with you the other day in overtime. Were you taken by surprise?
No, I thought the Fed was super boring yesterday. They didn't say anything different. There was no new surprises. It was all priced in. It was a big yawn, unfortunately.
You really think so? Because even Gundlach told me yesterday that, Powell is no longer behind the curve, that it was his best performance, that he essentially has his mojo back. And here's what he says about the idea of a hard landing, one that you say is coming and that one he has maintained is coming too, but maybe not so much anymore.
I'm going to say a crash landing is avoidable. I think that a soft-ish landing is your best case. I probably wouldn't give it great odds. I think we're going to have some noticeable economic distress, but I don't think it has to be really a free fall because Jay, I think, gets it now that he's in sync with the market.
How would you respond to that?
I mean, I do think it was a really great performance yesterday. I mean, look at other Fed meetings. Powell's been talking all about the risks and the geopolitical situation. There was no mention of anything negative yesterday. He was very optimistic in his tone outside of talking about inflation hurting individuals and certain people in the economy. But he was very, very positive, and I think the market is reading that as more dovish and that he gets that if he hikes policy rates, the other 100 basis points that's priced in as of yesterday, even before the 75 basis point hike, that he probably will tank the economy. So I think, I agree with the comments about, yeah, he did better. He does seem to get it now. But I also think you have to question whether the Fed hiking policy rates is going to have any implications on the supply side issues and whether it's going to get more people back into the labor market and increase that labor participation. I think the Fed hiking policy rates is just hitting the demand side, and we have all the other issues, which are pandemic related and geopolitical, that the Fed really doesn't have control over. And I think the markets are giving you this great opportunity because inflation expectations in the future are actually not very high. They're way below where realized inflation is. If you look at 10-year break-evens or the 5-year or the inverted yield curve, the market is saying future inflation expectations are very, very contained, very, very little over that 2% target.